Imagine a man who spent his entire career as a janitor. He never won the lottery. He never inherited a dime. He never climbed a corporate ladder or started a business. He simply mopped floors, emptied trash cans, and lived a quiet, unremarkable life in a small town in Vermont. When he died in 2014, he left behind an estate worth over $8 million. His name was Ronald Reed, and he had quietly amassed a fortune by patiently investing in blue-chip stocks and letting time do the heavy lifting. Around the same time, another man, a Harvard-educated finance executive with an MBA, a corner office, and a network of the most connected people in the world, filed for bankruptcy after a string of reckless, over-leveraged bets. His name was Richard Fuscone, and he had done everything you're supposed to do to become successful in finance. Yet money, in the end, didn't care about his credentials. Those two stories sit at the heart of a book that has quietly reshaped how millions of people think about money. The book is The Psychology of Money, and its author, Morgan Housel, isn't a Wall Street titan or a celebrity investor. He's a writer, a student of history, and a keen observer of the strange, irrational, often self-defeating ways humans behave around money. And his central argument is as simple as it is destabilizing. Doing well with money has almost nothing to do with how smart you are, and almost everything to do with how you behave. We've been told a story our whole lives. The story says that if you study hard, learn the formulas, and apply the right strategies, you'll master money. But the real world doesn't play by that script. The real world is messy. It's filled with people who know exactly what they should do and then do the opposite over and over for reasons that are deeply human. They panic during crashes. They get greedy during booms. They measure their self-worth against the possessions of strangers. And they make decisions not based on spreadsheets, but on fear, ego, pride, and a distorted sense of what will make them happy. This is the hidden layer beneath every bank statement and every investment portfolio, and it's the layer Housel invites us to explore. Over the next hour, we're going to walk through the most important insights from the psychology of money, not as a dry lecture on behavioral economics, but as a journey into the strange, emotional, deeply personal relationship each of us has with money. You'll learn why luck and risk are entangled in ways that make a mockery of pure merit. You'll discover why getting rich and staying rich are two entirely different skills, and why the latter is far more important. You'll understand the supreme value of freedom, the trap of social comparison, and the quiet, almost invisible nature of true wealth. And by the end, you'll have not just a new perspective, but a set of practical, behavior-first tools that you can begin applying to your financial life tonight. My promise to you is this: if you listen with an open mind, you will walk away with a kind of financial wisdom that no Excel spreadsheet can provide. You'll see your own money mistakes not as personal failures, but as human patterns you can learn to outsmart. And you'll begin to build a relationship with money that is less about chasing returns and more about building a life you actually want to live. That transformation starts now. There's a single, overarching idea that runs through every page of Morgan Housel's book, and once you truly absorb it, you'll never think about a paycheck, a stock ticker, or a retirement account the same way again. Financial success is not a hard science. It is a soft skill. The engine of wealth is not a mathematical formula. It's a set of behaviors, and those behaviors are shaped by forces that most of us barely understand. You can be a genius at calculus and still be a disaster with money. You can know every investing theory ever written and still panic sell at the bottom of a crash. Conversely, you can be a janitor with no formal financial education and still build an $8 million portfolio through patient, consistent behavior over decades. This is the fundamental insight that the rest of the book expands and deepens. Traditional education teaches us that money is about numbers, interest rates, price-to-earnings ratios, compound annual growth rates. But the real-world evidence tells a different story. Financial outcomes are wildly variable even among people with identical knowledge. Two investors can look at the same data and make opposite decisions, and both can believe they're being rational. That's because money decisions are not made in a vacuum. They are made in the context of a person's unique life experience, their generation, their upbringing, the economy they came of age in, and the stories they've told themselves about what money means. Someone who grew up in the high inflation 1970s will have a profoundly different relationship with risk than someone who entered the workforce during the booming 1990s. A person who watched their parents lose a home during the 2008 financial crisis will feel a level of fear about debt that someone raised in a stable, appreciating housing market will never quite understand. None of these people are crazy. They are all making decisions that make perfect sense given their own mental models of the world. The problem is that the financial world doesn't grade on a curve. It doesn't care about your personal history. It simply rewards certain behaviors and punishes others, often in ways that feel deeply unfair. Housel's approach is to study the patterns of behavior that tend to produce good financial outcomes over time, and the patterns that tend to destroy wealth, regardless of intelligence. He draws on history, on psychology, and on a rich collection of stories that illustrate how real people, not theoretical agents, interact with money. The rest of the book simply expands this idea outward into a series of lessons, each one a lens through which you can examine your own financial psychology. And the first, and perhaps most humbling of those lenses, is the tangled dance between luck and risk. In the 1960s, a man named Bill Gates attended a private school in Seattle that had the rare foresight to purchase a computer terminal at a time when most universities didn't even have one. He and a handful of friends were given virtually unlimited access to a machine that allowed them to learn programming years before almost anyone else on the planet. Gates is undeniably a genius, a once-in-a-generation mind. But he also won a cosmic lottery. That random, unrepeatable combination of time, place, and access played an incalculable role in the birth of Microsoft. Gates himself has said that without that school, there would be no Microsoft. Now flip the coin. His close friend and fellow computer club member Kent Evans was equally brilliant, equally driven. He died in a mountaineering accident before graduating high school. Same talent, same environment, radically different outcome. One is a household name, the other a footnote in a biography. The difference was not merit. It was a single, tragic roll of the risk dice. Housel's point is not that hard work and intelligence don't matter. They matter enormously, but they operate within a much larger framework of forces that no one controls. And the dangerous thing about success is that it tricks its recipients into believing they earned every bit of it, while failure tricks its recipients into believing they deserve their lot. The reality is far more nuanced. When you study extreme success, you are almost always studying a case where luck played a massive, invisible role. When you study extreme failure, risk often dealt a blow that no amount of skill could have parried. The practical implication is not to throw up your hands and stop trying. It's to hold your judgments more gently, both of others and of yourself. Don't worship the successful as infallible oracles, and don't scorn the unsuccessful as lazy failures. The world is more random than we're comfortable admitting. Now consider how this plays out in real life. A student from a wealthy family who lands a prestigious internship might attribute her success entirely to her own merit, not realizing that her parents' network opened the door. Later, when she becomes a hiring manager, she may unconsciously favor candidates who look like her, perpetuating a cycle that blends luck with opportunity. An employee who bought Bitcoin early and made a fortune might be hailed as a visionary, but he might have simply been in the right online forum at the right time. If he then parades his success as proof of his investing genius, he may lead followers into ruin. A business owner who launched a restaurant just before a pandemic and went bankrupt may blame herself entirely, not accounting for the catastrophic timing she could never have predicted. An investor who got wiped out by a sudden market crash might have done everything right by historical standards and simply hit a risk event that no model saw coming. What can you do with this insight tomorrow? Conduct a luck and risk audit on a recent financial success or failure in your life. Write down the outcome. Then draw a line down the middle of a page. On the left, list every factor that was within your control, your effort, your research, your decisions. On the right, list every factor that was outside your control: market conditions, timing, the actions of other people, pure chance. Look at the balance. This isn't about diminishing your achievements, it's about seeing them clearly. When you internalize the role of luck, you become less arrogant, more compassionate, and far more likely to build in the safety margins that protect you from risk. A common mistake is to use the luck and risk framework as an excuse for passivity. If everything is luck, why bother trying? That's a fundamental misunderstanding. Effort and skill compound your odds, even if they never guarantee an outcome. Another mistake is to apply this insight only to others, to dismiss their success as luck while attributing your own to hard work. The true value is in applying it first to yourself. The limitation here is that some people face systemic barriers that make luck and risk a much crueler equation. Being born into poverty, into a marginalized community, or into a country with a collapsing economy is not a mere roll of the dice. It's a structural reality that personal effort alone cannot easily overcome. Housel's framework is a psychological tool for individual humility, not a political argument about the fairness of the world. In the modern age of social media, we are constantly bombarded with extreme success stories curated to look like pure merit. The 25-year-old crypto millionaire, the overnight YouTube star. We see the outcome, never the invisible scaffolding of luck and circumstance that propped it up. The result is a collective delusion that success is entirely controllable, which breeds anxiety and self-blame. Recognizing luck doesn't deflate ambition, it deflates arrogance. And it opens the door to a much more stable, resilient kind of success, the kind you can keep. That brings us to the next crucial lesson, the profound difference between getting rich and staying rich. There are countless books about how to make money, far fewer about how to keep it. And yet, Housel points out, the skill of keeping money is completely different from the skill of making it. Getting rich often involves optimism, risk-taking, and a certain amount of boldness. Staying rich involves the opposite: humility, paranoia, and a healthy fear that what you've built can be lost in an instant. If getting rich is the offense, staying rich is the defense, and a great defense can win championships even when the offense has an off day. Consider the story of Jesse Livermore. He was one of the greatest stock traders of the early 20th century, a legend on Wall Street who made and lost multiple fortunes. He had an almost supernatural ability to read markets and make money, but he lacked the skill of keeping it. He leveraged too heavily, bet too big, and eventually lost everything. He ended his life a suicide, a cautionary tale of what happens when getting rich is the only skill you cultivate. Now contrast him with someone like Ronald Reed, the janitor we met earlier. He never made a fortune in a single year. His brilliance was not in earning spectacular returns, but in holding on decade after decade through up markets and down markets, letting compounding do its silent, unglamorous work. Housel introduces a simple but powerful principle. To stay rich, you must combine the optimism that lets you take risks with the paranoia that protects you from ruin. You must believe that the future will get better, because over the long arc of history, it generally does, while also knowing that the path between here and there will be filled with terrifying landmines. The trick is to survive the landmines so you can reach the better future. In practical terms, a student who receives a large signing bonus might be tempted to invest it all in a hot stock tip. The getting rich instinct is roaring. The staying rich instinct would say, put most of it in a boring index fund, keep 6 months of expenses in cash, and gamble with only a tiny slice if you must. An employee who has built a comfortable 401k might, during a bull market, be tempted to shift everything into aggressive growth funds. The staying rich instinct remembers that bear markets happen, that jobs can be lost, and that diversification is the armor that lets you sleep at night. A business owner whose company suddenly becomes profitable might immediately lease a fancy car and upgrade her office. The staying rich instinct reinvests profits into a cash buffer and sustainable growth before upgrading her lifestyle. An investor who has had a series of winning trades might feel invincible. The staying rich instinct sizes positions so that no single loss can knock her out of the game. Tomorrow, take an honest look at your own financial defenses. Do you have an emergency fund that can cover 6 months of expenses if your income disappears? Are you diversified across different types of assets? Do you have adequate insurance? These are the unglamorous, boring tools of staying rich. If you don't have them, make a plan to build them. It's far less exciting than chasing the next 10-bagger stock, but it's what keeps you in the game. A classic mistake is interpreting this as a call to extreme conservatism, to hoard every penny and never take a risk. Housel is clear. Without risk, there is no reward. The art is to take enough risk to grow, but not so much that a single blow destroys you. Another mistake is confusing staying rich with never losing money. You will lose money. The goal is to lose in ways you can recover from. There is a limitation here. Building a defensive financial fortress assumes you have enough income to cover basic needs and still have something left to protect. For someone living paycheck to paycheck, staying rich sounds like a distant luxury. Yet even at modest income levels, the principle of protecting what you have, through an emergency fund, through avoiding predatory debt, is the foundation on which getting rich can later be built. In the modern economy, staying rich has become both harder and easier. Harder because inflation can silently erode purchasing power, and easier because automated savings, target date funds, and robo-advisors provide built-in defensive mechanisms for those who use them. The key takeaway: you can make a lot of money and still end up with nothing if you haven't mastered the quiet art of keeping it. Wealth is the money you don't spend on things that don't matter. And once you protect it, something magical begins to happen, something that is mathematically inevitable yet psychologically almost impossible to grasp. Compounding. Imagine a lake. There's a single lily pad on its surface. The lily pad doubles in size every day. On the 30th day, it will cover the entire lake. The question is, on what day does it cover half the lake? The answer is the 29th day. For 28 days, the growth seems negligible, barely noticeable. A tiny green speck grows a little larger, but the lake still looks wide open. Then, in a single astonishing day, it doubles from half-covered to completely covered. That's compounding, and it is the single most powerful force in finance, yet it is also the hardest to internalize because the human brain evolved to think linearly, not exponentially. We expect progress to be steady, visible, and immediate. Compounding is none of those things. It is backloaded, invisible for most of its duration, and then in its final stages explosive. Warren Buffett is often cited as the ultimate example of compounding. What's less often noted is that the vast majority of his wealth was accumulated after his 65th birthday. He wasn't a slouch before that. He was already wealthy. But the curve of his net worth is a classic compounding curve, flat for decades, then a dramatic upward sweep. The secret is not just his investing skill. It's that he started investing as a teenager and has been at it for over 80 years. Time, more than genius, is the engine. Housel drives this home with a sobering thought. If you want to capture the magic of compounding, you must give it the one thing no one can buy: time. And that means starting early, yes, but it also means not interrupting the process. The greatest destroyer of compounding is not a low return. It's the investor who panics, sells, and sits out during the recovery. Every time you break the compounding chain, you reset the lily pad back to day one. For a student in her early 20s, this is both a gift and a challenge. She can start investing a tiny amount, $50 a month, in a low-cost index fund, and because she has 40 years for it to compound, that tiny stream will likely grow into a substantial sum. But she must also endure the psychological test of watching it barely move for years before the curve bends upward. An employee in his 30s who suddenly realizes he's behind on retirement savings might panic and take excessive risks to catch up, breaking the compounding chain. The better move is to dramatically increase his savings rate and let the time he still has work its quiet magic. A business owner who reinvests profits consistently for 2 decades, rather than extracting every dime of profit each year, is harnessing compounding within the company. An investor who reinvests dividends rather than spending them is letting the lily pads double. Starting tomorrow, calculate your personal compounding horizon. How many years until you plan to use the money you're investing? Write that number down. Then, whenever you feel the urge to tinker, to sell, to chase a fad, look at that number. Remind yourself that the goal is not to reach the finish line today. The goal is to keep the lily pads doubling until the day you truly need the lake to be covered. A common mistake is assuming that compounding requires huge starting capital. In fact, it requires time and consistency more than a large principal. Small, steady contributions over decades crush large, sporadic investments over short periods. Another mistake is obsessing over the rate of return. Yes, a higher return helps, but the truly uncontrollable variable is time. Focus on what you can control: how much you save, how consistently you invest, and how long you can stay invested without interrupting the process. The limitation is that not everyone has the luxury of a 40-year horizon. A person who starts in her 50s after a lifetime of financial struggle cannot simply rewind time. In that case, other principles, like a high savings rate and realistic expectations, become even more critical. Compounding still works. The curve is just compressed. In the modern world where day trading apps and crypto cycles promise instant riches, compounding seems painfully slow. It is unfashionable. It generates no notifications, no dopamine hits. But it remains the one financial force that reliably turns modest effort into extraordinary outcomes. The takeaway: patience is the ultimate edge. The lily pad will cover the lake, but only if you stop pulling it out of the water. And the deepest reason to keep the chain going isn't to buy more things. It's to buy something far more valuable: control over your time. Morgan Housel writes that the highest form of wealth is the ability to wake up every morning and say, "I can do whatever I want today." Not necessarily to lounge on a beach, although that's lovely, but to have complete autonomy over your time. No boss can fire you. No client can pressure you. No alarm clock can force you out of bed unless you choose it. This, he argues, is the ultimate dividend that money pays, and it's the dividend most people overlook. He tells the story of a man named Derek, a valet who worked at a hotel for decades. Derek saved diligently, invested in stocks, and quietly amassed a portfolio that allowed him to retire with a paid-off house and enough to live comfortably. When asked what his new life looked like, he said he spent his days visiting his grandchildren, gardening, and doing odd jobs for friends. He didn't travel the world or buy a yacht. He simply controlled his time. And he was, by all accounts, deeply content. Contrast that with a high-powered CEO earning millions who is tethered to a phone, a schedule, and a board of demanding shareholders. She has immense monetary wealth, but almost no control over her waking hours. Who is truly richer? Housel's answer is clear: the one with more control. Psychologists have long known that a sense of autonomy is one of the strongest predictors of well-being. Studies show that people are happier when they feel in control of their lives, even if their material circumstances are modest, than when they have luxury but no freedom. Money's greatest power is to give you that autonomy, but it can only do that if you don't simultaneously accumulate obligations that chain you back down. For a student, this lesson might shape career choices. The high-paying consulting job that demands 80-hour weeks and constant travel might seem like the obvious goal. But if it leaves no room for the relationships and hobbies that make life meaningful, it might be a gilded cage. The slightly lower-paying job with flexible hours and a reasonable pace might, over a lifetime, yield more happiness. An employee who has saved enough to have a runway of several months can negotiate, push back, or leave a toxic situation without desperation. That's freedom purchased by past financial discipline. A business owner who builds systems so that her company can operate without her constant presence has bought herself time, the true profit. An investor who has built a portfolio that covers basic living expenses no longer needs to work, which means any work she does is a choice. That is the finish line that matters, far more than any arbitrary net worth number. Tomorrow, ask yourself a simple question. On a scale of 1 to 10, how much control do you feel over your time? If the number is lower than you want, identify the one obligation, a debt, a commitment, an expense, that most limits your freedom. Make a plan to reduce or eliminate it. The goal is not to drop everything and retire tomorrow. It's to inch toward a life where you call the shots. A common mistake is to pursue money for its own sake, without asking what it's actually buying. You can accumulate a fortune and still be a prisoner to schedules, expectations, and a lifestyle that consumes every dollar you make. Another mistake is to assume that control means doing nothing productive. Most people who achieve financial autonomy still work, create, and contribute. They just do it on terms they choose. The limitation is that this principle can feel like a taunt to someone who cannot leave a bad job because she must provide for dependents. Control is a spectrum, and for many it's a luxury that takes years to earn. But even a small increase in autonomy, saving enough to take an unpaid mental health day, negotiating a remote work arrangement, is a step in the right direction. In the modern gig economy, the illusion of control is everywhere. You can set your own hours driving for a rideshare app, but if the algorithm determines your pay and your schedule, how much control do you really have? True financial autonomy is about having enough assets that your labor becomes optional, not just flexible. The takeaway: when you evaluate a financial decision, don't just ask, "Will this make me more money?" Ask, "Will this give me more control over my time?" That's the real wealth. And it's a wealth that is often invisible to the outside world, which brings us to a paradox. The things that look like wealth are often its exact opposite. Morgan Housel drives past a man in a brand new Ferrari. The man looks miserable, hunched over the wheel, stuck in traffic. Housel reflects on the strange reality that when you see someone driving a Ferrari, you don't think, "Wow, that driver is so cool." You think, "Wow, if I had that car, people would think I'm cool." Then you mentally put yourself in the driver's seat, imagining the admiration of others. But the actual driver gets almost none of that admiration. He's just a person in a car. Most people on the street barely glance at him, and those who do are mostly thinking of themselves. This is what Housel calls the man in the car paradox. We buy extravagant things because we think they'll make us admired, but the admiration we imagine is a projection of our own psychology. The object itself conveys almost none of the status we expect. This paradox points to a deeper truth. Wealth is what you don't see. The money that is spent on a luxury car, a designer handbag, or a massive house is money that has been converted from an asset into a liability, or at least into a visible object. But the truly wealthy person often looks nothing like our stereotype of wealth. She drives an old Toyota, lives in a modest house, and wears unbranded clothes. Why? Because her money is invisible. It's sitting in retirement accounts, in index funds, in the equity of a quietly growing business. It's not parading around announcing itself. And because it's not being spent on status symbols, it's quietly compounding, creating more freedom for its owner every single day. Housel uses the example of a pop star who spent lavishly and ended up broke, while a middle-class couple with steady jobs and a high savings rate amassed a quiet fortune. The pop star looked wealthy. The couple did not. The pop star was, in financial reality, poor, or at least fragile. The couple was rich. This is the great inversion that so few people grasp. Wealth is the money not spent. It's the cars not bought, the watches not worn, the renovations not undertaken. It's the accumulated potential of deferred consumption that gives you options, security, and control over your time. A student who lands her first job and immediately buys a luxury car on a loan has signaled to the world that she's successful, but she's actually just saddled herself with a liability that will drain her future income. She looks rich, but she's made herself financially fragile. Another student, earning the same salary, who buys a reliable used car and invests the difference, looks less impressive but is quietly building actual wealth. An employee who gets a raise and upgrades to a bigger house with a bigger mortgage may look like he's moving up, but he's actually decreased his financial margin and increased his stress. A business owner who plows profits back into the company, rather than taking an extravagant salary, looks less flashy than her competitors, but she's building an asset that can fund her freedom later. An investor who resists the urge to tap her portfolio for a luxury purchase lets the invisible money continue compounding. Tomorrow, conduct a visible vs. invisible audit. Look at your recent spending and divide it into two columns: things you bought that others can see, and things you bought or saved that no one sees. Be honest. The ratio tells you something about your relationship with wealth. The goal isn't to eliminate visible spending entirely. It's to be conscious of whether you're spending for your own enjoyment or for the imagined approval of strangers. A common mistake is to swing to an extreme of miserliness, denying yourself any pleasure because all visible spending is somehow sinful. Housel's point is not that you should never buy nice things. It's that you should buy them for the right reasons, because you genuinely value them, not because you think they'll make other people value you. Another mistake is judging others who spend visibly, assuming they are financially fragile. They may have already accumulated substantial invisible wealth and are simply enjoying a portion of it. The principle is a mirror, not a magnifying glass for others. The limitation is that some cultures and professions require a certain visible display to function. A salesperson driving a luxury car to signal success to clients, for instance. Context matters. The deeper point is not to let the signaling become a trap that consumes wealth you don't have. In the age of Instagram, the man in the car paradox is amplified to a deafening volume. Influencers rent private jets for photo shoots, presenting a facade of wealth that is often entirely fictional. The pressure to match these curated images drives people to spend money they don't have on things that won't bring lasting happiness. The antidote is to remember that true wealth is quiet, invisible, and patient. The takeaway: the next time you're tempted to buy something to impress others, remember that most of those others are too busy thinking about themselves to notice. Spend your money on freedom, not applause. And that requires a skill that's deceptively simple but psychologically demanding. The simple act of saving money. Saving money is not about depriving yourself. It's about claiming control. Housel argues that the most powerful lever in personal finance is not investment returns, not tax strategies, not picking the next hot stock. It's your savings rate. The percentage of your income that you keep is something you control almost entirely. Returns, markets, and the economy, you don't control those. But your savings rate is a function of your lifestyle choices and your discipline, and it has a far greater impact on your financial future than squeezing out an extra percentage point of return. He makes a counterintuitive point. Saving money doesn't require a specific reason. You don't need to save for a down payment, or a vacation, or retirement, though those are fine goals. You can save simply because saving gives you options, and options are the raw material of a good life. When you have a cushion, you can take a career risk, start a business, weather a medical crisis, or simply sleep better at night. The purpose of saving is to give your future self more possibilities than your present self has. It's the gap between what you earn and what you spend that creates that possibility, and you can widen that gap either by earning more or by spending less. The second path is often faster and always more within your control. The stories of the stealthy wealthy, the janitors, the middle-class couples, the quiet millionaires, all share one trait: a high savings rate relative to their income. They didn't starve themselves or live miserably. They simply decided that a certain portion of every dollar that passed through their hands would be redirected toward their future selves. They defined their lifestyle by their values, not by their neighbors' expectations, and the gap between income and spending grew year after year, silently filling their asset columns. For a student, saving might feel impossible when income is low. But even saving $5 a week, the cost of one coffee, begins to build the muscle. The habit is more important than the amount. An employee who gets a raise can choose to save the entire increase and continue living on the prior year's salary, a painless way to rapidly increase savings rate. A business owner can set up a system where a percentage of revenue is automatically swept into a separate account before she ever sees it. An investor can reinvest dividends rather than treating them as spending money. Tomorrow, Calculate your current savings rate. Take your monthly after-tax income and subtract your monthly spending. Divide the difference by your income. That's your savings rate. If it's below 10%, set a realistic goal to increase it by 1 percentage point per month for the next 6 months. You can do this by cutting a small subscription, cooking one more meal at home, or negotiating a bill. The feeling of watching that number rise is more satisfying than any purchase it replaces. A common mistake is to focus exclusively on cutting costs, which can feel like punishment, while ignoring the other side of the equation, increasing income. The ideal is a balanced approach, earn more and spend less, so that the gap widens without misery. Another mistake is to assume that a high income automatically produces a high savings rate. Plenty of high earners spend every dollar they make, and then some. Savings rate is a behavior, not a mathematical consequence of income. The limitation is that at very low income levels, the basic cost of survival can consume almost everything, leaving no room to save. This is not a failure of character, it's a structural reality. In such cases, the focus should be on increasing income first, while practicing the mental habit of saving whatever tiny amount is possible, just to build the identity of a saver. In today's consumer culture, engineered to extract every dollar with algorithmic precision, saving is an act of quiet rebellion. It's saying to a system that wants you perpetually spending that you value your freedom more than your stuff. The takeaway: your savings rate is the gap between your ego and your income. Widen that gap, and you widen your future. But even the most disciplined saver faces a psychological challenge. We are all terrible at predicting what will actually make us happy in the future. That's the next lesson, and it's a humbling one. Morgan Housel points out a universal truth that is obvious yet constantly ignored. You will change. The person you are today, with your current desires, values, and priorities, is not the person you will be in 10, 20, or 40 years. Yet we make long-term financial decisions as if the current version of ourselves will remain in charge forever. We lock ourselves into careers, mortgages, and investment strategies that a future version of us, a person with different dreams, different tolerances, different needs, may deeply resent. This is not a failure of planning. It's a feature of being human. Psychologists call it the end of history illusion. At any given point in our lives, we recognize that we have changed dramatically from who we were a decade ago. We can look at old photos and barely recognize that person. And yet, when we imagine the future, we assume that the person we are right now is the final, finished version. We believe that our current preferences are permanent. The evidence says otherwise, loudly and universally. Housel applies this to money. Avoid the extreme ends of financial planning. Don't make decisions that require you to maintain a specific set of preferences for the rest of your life to be happy. Don't lock yourself into a lifestyle that leaves no room for change. The person who signs up for a massive mortgage on the assumption that she'll always want to live in that city and work that high-stress job is betting against her own future self, and that bet often loses. The person who delays all enjoyment until retirement is betting that her 70-year-old self will have the same health, energy, and desires as her 30-year-old self. That bet also often loses. A student choosing a college major might feel immense pressure to pick a path that leads to a specific career. But the wise student leaves herself some flexibility, knowing that her 25-year-old self may want something entirely different than her 18-year-old self imagined. An employee who gets a promotion might be tempted to inflate her lifestyle to match the new salary, locking her future self into a treadmill she can't easily step off. The wiser move is to enjoy the raise modestly and save the rest, preserving the option to change course later. A business owner who builds her entire identity around the company may find, after selling it, that she feels utterly lost. Building a life with multiple pillars of meaning, family, hobbies, community, protects against the shifting sands of identity. An investor who goes all in on a single strategy that requires constant attention and a high risk tolerance may find that a decade later, With children and a desire for calm, she can no longer sustain it. What you can do tomorrow is a simple but revealing exercise. Write a letter to your future self, 10 years from now. Describe what you hope your life looks like, what you value, what you worry about. Then write a letter to your past self from 10 years ago, acknowledging how much you've changed since then. The contrast will make the lesson visceral. When making long-term financial decisions, ask, does this plan allow for the reality that I will be a different person in a decade? If the answer is no, build in more flexibility. A common mistake is interpreting this as a call to avoid all commitment. Commitment is necessary for many of life's greatest rewards: marriage, career mastery, raising children. The point is not to avoid commitment, but to avoid financial commitments that are irreversible or that assume static preferences. Another mistake is using future change as an excuse for chronic indecision. There's a difference between healthy flexibility and perpetual paralysis. The limitation is that some major life decisions, having a child, for instance, inherently involve profound, irreversible change. This principle helps you design the financial container around those decisions with more flexibility, not avoid the decisions themselves. In the modern era, the end-of-history illusion is accelerated by rapid technological and social change. A career that exists today may be automated tomorrow. A city that is thriving now may be unaffordable or transformed in a decade. The most resilient financial plan is one that assumes change and builds in margin. The takeaway: you are a moving target. Your financial plan should be a flexible framework, not a rigid cage. And nowhere is flexibility more important than in your expectation of how the world itself will behave. Because the future, as history teaches us, is consistently surprising. If you studied the stock market in 2007 and built a plan based on the previous 50 years of data, that plan would have been shattered by 2008. If you studied the economy in 2019 and projected forward, 2020 would have made a mockery of your spreadsheet. The future is not a predictable extension of the past. It is a chaotic, non-linear system that regularly produces events no one saw coming. Housel argues that this is not a bug in the world, it's a feature. And the appropriate response is not to build better prediction models. It's to build a financial life that can survive a wide range of possible futures, many of which will be surprising. He uses the example of the Great Depression. No model predicted its depth or duration. Those who survived financially were not the ones who had anticipated the crash. Almost no one did. But those who had enough margin, enough cash, and enough patience to endure it without being wiped out. The same pattern repeats in every crisis. Survivors are not prophets. They are people who built their structures with enough humility to acknowledge that the world is unpredictable. This has a direct, practical application. The single most underrated financial skill is the ability to be reasonable rather than perfectly rational. Academic finance prizes rationality, the mathematically optimal choice. But in the real world, a perfectly rational choice that you can't stick with emotionally is far worse than a reasonable choice you can live with through thick and thin. A perfectly rational portfolio might be 100% stocks for the highest long-term expected return. But if that portfolio causes you to panic sell during a crash, it's irrational in practice. A reasonable portfolio might be 60% stocks, 40% bonds with a cash cushion, a mix that lets you sleep at night and stay invested. That's the reasonable choice, and it's the one that wins over time. For a student, this might mean choosing a career that balances passion and practicality, rather than one that maximizes only income or only passion. For an employee, it means choosing a job that pays well enough and offers a life you enjoy, rather than burning out in a high-paying gilded cage. For a business owner, it means growing at a sustainable pace rather than swinging for the fences on every project. For an investor, it means owning assets you understand in proportions that match your real risk tolerance, not a theoretical ideal. Tomorrow, review your biggest financial decision and ask, was this perfectly rational on paper but emotionally unsustainable in practice? If the answer is yes, consider a reasonable adjustment. The goal is to align your money with your actual psychology, not with a textbook. A common mistake is to use reasonable as an excuse for laziness, to avoid learning the rational approach altogether. The ideal is to understand the rational optimum, then deliberately adjust it to fit your human nature. Another mistake is to assume that what is reasonable for you is reasonable for everyone. Your reasonable portfolio is not your neighbor's. The limitation is that some financial situations genuinely require optimal, not just reasonable, choices. Managing a large institutional fund, for example, or navigating complex tax situations. But for individual households, reasonableness is almost always the higher virtue. In today's hyper-optimized culture, where apps and influencers promise the perfect strategy, reasonableness sounds boring. But boring is beautiful when it keeps you in the game. The takeaway: a reasonable plan you can stick with is worth infinitely more than an optimal plan you abandon. And one of the most important components of a reasonable plan is something entirely within your control: the margin of safety known as room for error. Morgan Housel tells the story of a friend who had a gambling problem. The friend knew that if he went to a casino with cash, he would lose whatever he brought. So he instituted a rule. He could only bring the amount of money he was willing to lose, and he left his ATM card at home. He built a structural barrier between his impulses and his ruin. This, Housel says, is the essence of room for error. It's the financial equivalent of leaving the ATM card at home. It's the cash buffer, the conservative estimate, the diversified portfolio, the insurance policy. It's the gap between what you think will happen and what you can survive if you're wrong. And you will be wrong, often, and at the worst possible times. The concept is simple but underused. Assume that your projections are too optimistic. Assume that the market can drop 50% and stay there for a decade. Assume that you could lose your job at the same moment your roof needs replacing. You don't live your life in fear of these things. You simply structure your finances so that if any of them happen, you're inconvenienced, not destroyed. The margin of safety is what turns a potential catastrophe into a manageable problem. He applies this to investing with a powerful thought experiment. If you need your portfolio to grow at 10% a year to retire comfortably, you've left no room for error. A few bad years and your plan is broken. But if your plan works even if your portfolio grows at 6% or 4%, you have room. You can sleep. You can stay invested during downturns. The irony is that the person with more room for error often ends up with higher returns, not because she took more risk, but because she was able to stay invested when the person with no room for error panicked and fled. A student who budgets every dollar to the limit, with no buffer for unexpected expenses, is one car repair away from financial chaos. A student who keeps even a small cash reserve has room for error. An employee who spends her entire paycheck each month, assuming the job will always be there, is one layoff away from crisis. An employee with an emergency fund has months of runway. A business owner who leverages everything on a single product launch has no room for error. One that maintains a cash reserve and a diversified customer base can survive a failed launch. An investor who uses margin debt to amplify returns has removed all room for error. A margin call can wipe out a lifetime of work. An investor who buys assets outright and holds cash can ride out any storm. Starting tomorrow, identify the single point in your financial life where you have the least room for error. Maybe it's a lack of emergency savings. Maybe it's a concentrated investment position. Maybe it's a job that could disappear without warning. Choose one action to widen that margin. Open a savings account, diversify a holding, update a resume. The peace of mind is instantaneous. A common mistake is to overestimate your own risk tolerance and undercalculate the margin you need. People tend to assume they can handle more volatility than they actually can when the storm hits. Build the margin for your emotional self, not your aspirational self. Another mistake is to hoard so much room for error that you never take any risk at all. The goal is enough margin to survive and thrive, not an infinite bunker. The limitation is that building room for error requires resources that some people don't yet have. If you're living on the edge, you can't instantly create a 6-month emergency fund. But you can start with a tiny margin, $10 in a separate envelope, and build from there. The principle scales. In a world of black swan events from pandemics to flash crashes, room for error is no longer optional. It's the price of admission. The takeaway, the most important question in finance is not what will I earn, but what can I survive? Answer that honestly and you've built a fortress. But even the strongest fortress can be undermined by a subtle, pervasive force that masquerades as intelligence, the seductive pull of pessimism. Turn on any financial news channel, scroll through any social media feed, and you'll be bathed in pessimism. The market is about to crash. The economy is a house of cards. The system is rigged. Pessimism sounds smart. It sounds sophisticated. It taps into our evolutionary wiring. Our ancestors who worried about the rustling in the bushes survived, while the optimists got eaten. Pessimism is intellectually seductive because it implies that the pessimist sees a hidden truth that the naive masses miss. Optimism, by contrast, sounds like a sales pitch. It sounds gullible. And yet, Housel points out, almost every long-term trend in modern economic history has been upward. Pessimism makes great headlines. Optimism makes great wealth. He's not advocating blind cheerfulness. He's pointing out a psychological asymmetry. The problems in the world are real, and they are vividly covered. The slow, grinding progress, declining poverty, rising life expectancy, the steady upward march of the stock market over decades, is boring and invisible. The nightly news will never lead with a story about how many people were lifted out of extreme poverty today, but that number is in the hundreds of thousands, every single day. The seduction of pessimism leads investors to sell at the bottom, to hoard cash during inflationary periods, to miss the long, slow climb because they're convinced a crash is imminent. The crash may come, but over a lifetime, the optimist who stays invested almost always wins. A student who believes the economy is rigged and that her efforts don't matter may never fully invest in her own skills. That's a self-fulfilling prophecy. An employee who constantly listens to doom and gloom pundits may become so risk-averse that she never invests her savings, losing purchasing power to inflation year after year. A business owner who buys into the narrative that a recession is imminent may pull back on necessary investment, missing the upside of the eventual recovery. An investor who is seduced by the intellectual glamour of pessimism may hold too much gold, too much cash, too many hedges, and miss the compounding that equity markets have delivered for centuries. What can you do tomorrow? Curate your information diet. For 1 week, replace every source of financial pessimism you consume, whether it's a YouTuber, a Twitter account, or a news segment, with a source that provides long-term, data-driven perspective, like the historical returns of the S&P 500 or the global progress statistics compiled by organizations like Our World in Data. Notice how your emotional state shifts. Optimism is not naivety. It's a recognition of the long-term historical record. A common mistake is to swing to blind optimism and ignore genuine risks. The goal is to be a realistic optimist, someone who understands that the future will be messy and painful in the short term, but that the long arc bends upward, and that the only way to capture that arc is to stay in the game. Another mistake is to dismiss the concerns of pessimists entirely. They often highlight real vulnerabilities. The art is to hear the warning while rejecting the paralysis. The limitation is that some periods in history genuinely have been catastrophic for long-term investors. Think of Germany in the 1930s or Japan after 1989. Diversification across countries and assets is the practical safeguard against a single nation's lost decades. In today's attention economy, pessimism is a product designed to keep you watching. Fear generates clicks. Optimism is quiet and slow. To build wealth, you must consciously tune out the noise and tune into the long arc. The takeaway: the cynic sounds clever, but the disciplined optimist builds wealth. And sometimes, the stories we tell ourselves become so powerful that they override even the most obvious facts. That's the next and final lesson. The stories we believe about money can make us or break us. Humans are not spreadsheets. We are storytellers. We make sense of the world through narrative, and those narratives shape our financial decisions more than any data set. Housel tells the story of the dot-com bubble, when investors poured money into companies with no earnings, no business models, and no clear path to profitability, simply because the story of the internet revolution was so compelling. The story contained a kernel of truth. The internet did, in fact, change the world. But the story overwhelmed the numbers, and when the numbers reasserted themselves, trillions of dollars vanished. The same dynamic plays out in every bubble, every mania, every panic. He argues that the most dangerous financial narratives are the ones that are partly true. They capture a genuine insight, but they amplify it to an extreme. Real estate only goes up. Partly true, over long periods it tends to appreciate, but in the short term it can crash catastrophically. This time is different. Partly true, every era has unique characteristics, but human psychology is remarkably constant. The stories we tell ourselves about what money means, that it equals worth, that it guarantees happiness, that it will solve all our problems, are the most personal and the most powerful, and they are often completely invisible to us. A student may believe the story that her degree must lead to a high-income career, regardless of her interests, because money equals security. That story may lead her to a life of material comfort and quiet misery. Another student, believing a different story, that work should be meaningful even if it pays less, may end up struggling financially, stressed and resentful. Neither story is objectively true. Both are narratives that shape decisions. An employee may tell himself the story that he's not good with numbers, so he'll never invest. That story becomes a self-imposed ceiling. A business owner may believe the story that she must grow at all costs, chasing a valuation rather than building a sustainable enterprise. An investor may be swept up in a compelling narrative about a new technology and invest without ever looking at the balance sheet. The practical action is to become aware of your money stories. Tomorrow, take a piece of paper and write down the sentence, "Money is." Fill in the blank with whatever comes to mind first: security, freedom, evil, the root of all problems, the measure of success, a game, a trap. Then write another sentence: rich people are, and another: I'm the kind of person who with money. These are your money stories. Ask yourself where you learned them. From a parent, from a painful experience, from a cultural message. Ask whether they are serving you or limiting you. You don't need to change them overnight. Just seeing them clearly begins to loosen their grip. A common mistake is to think you can simply adopt a new story by repeating an affirmation. Stories that are deeply rooted in experience don't yield to surface-level positive thinking. They yield to new experiences that contradict them. If you believe you're bad with money, start with one small financial success, saving $100, investing your first share, and let the experience write a new story. Another mistake is to assume that everyone shares your money story. They don't. Understanding that difference is the foundation of financial empathy. The limitation is that some money stories are reinforced by powerful social and economic systems. A person who has experienced generational poverty may have a story that the system is rigged, and that story contains significant truth. Changing the internal story doesn't change the external system, though it may change how one navigates it. In the modern world, narratives spread faster than ever. A viral tweet can create a buying frenzy or a panic in hours. The ability to step back and ask, is this story true or is it just compelling, is a financial survival skill. The takeaway: you are the author of your money story, even if you didn't realize you were holding the pen. Write one that serves the life you want, not one that traps you in a plot you never chose. We have traveled through a rich landscape of ideas drawn from the psychology of money, but no book is beyond criticism, and a mature engagement with these ideas requires acknowledging the pushback they have received. Academics and financial economists note that Housel's work is not a rigorous empirical study. It is a collection of essays built around anecdotes and historical vignettes. The behavioral patterns he describes are real: loss aversion, recency bias, overconfidence. But they have been studied in controlled settings by researchers like Daniel Kahneman and Richard Thaler. Housel's contribution is to translate that academic work into vivid, relatable stories. Critics argue that this translation sometimes oversimplifies the science, turning nuanced statistical findings into catchy maxims that can be misapplied. Some financial professionals criticize the book for underemphasizing the role of systemic factors: tax policy, wage stagnation, healthcare costs, housing affordability, that shape individual financial outcomes. By focusing on individual behavior, Housel risks implying that anyone who struggles financially simply needs to fix their psychology. This is a valid concern. Bad luck and systemic barriers can overwhelm good behavior, and no amount of financial stoicism can substitute for a living wage or affordable health care. Modern critics also point out that the book's investment advice, essentially, buy and hold a diversified portfolio, is sound but not novel. The book's value is not in providing new strategies, but in providing the psychological tools to stick with the strategies everyone already knows. Still, some readers looking for tactical guidance may come away disappointed. What do experts generally agree with? The book's core insights are deeply aligned with the best of behavioral finance. The recognition that money is emotional, that time is the most powerful variable in compounding, that getting rich and staying rich are different skills, that reasonable trumps rational, and that wealth is what you don't see. These are all invaluable correctives to a finance culture obsessed with complexity and prediction. The book's emphasis on humility, patience, and self-awareness is a necessary antidote to the get-rich-quick mentality. A balanced view is that the psychology of money is not a comprehensive financial manual. It is a behavioral mirror. It shows you your own reflection so you can see the patterns that help or hinder you. It should be read alongside practical financial education, learning about budgeting, investing, taxes, and estate planning. But without the psychological foundation Housel provides, even the best technical knowledge often goes unused. The book is a complement, not a substitute. And with that understanding, let's look at how these principles function in the world we actually inhabit today. Morgan Housel wrote his book before the wild market swings of the post-2020 era, but his principles feel almost prophetic now. In a world of high inflation, speculative crypto booms and busts, meme stocks, and an attention economy that monetizes fear and greed, the psychology of money has never been more relevant. Inflation is a textbook case of the seduction of pessimism and the importance of room for error. When prices rise, the instinct is to hoard cash or to make desperate bets to outrun inflation. But the long arc of history shows that diversified assets, stocks, real estate, and even inflation-protected bonds have generally preserved purchasing power. The person who panics and exits the market to hold cash locks in losses. The person who remains calm, maintains a diversified portfolio, and perhaps increases their savings rate to compensate, rides through the storm. The rise of AI and automation introduces new dimensions of luck and risk. Entire industries are being reshaped. A career that seemed safe for a lifetime may be disrupted. The principle of flexibility and the end of history illusion becomes critical. The person who assumed her career path was linear must now adopt a mindset of continuous learning, building multiple income streams, and keeping fixed expenses low so that pivoting is possible. The reasonable approach is to embrace the opportunities of AI while building a financial cushion that can absorb a career transition. Remote work, accelerated by the pandemic, has made the principle of control over your time even more tangible. For many, the experience of working from home was a taste of freedom that no salary increase could replace. The quest for financial independence has grown in part because people have experienced how life feels when they reclaim hours lost to commuting and office politics. This is the highest form of wealth in action. The digital creator economy and the rise of side hustles embody both the reasonable over rational principle and the importance of savings rate. A person can now build a small asset, a YouTube channel, a Substack newsletter, a digital product, with almost no upfront capital. The rational choice might be to stay in a secure job. The reasonable choice might be to spend evenings building something that can eventually provide both income and autonomy. The extra income, if saved rather than spent on lifestyle inflation, widens the gap between earnings and expenses, accelerating the path to freedom. Exchange-traded funds and index funds are the perfect vehicles for Housel's philosophy. Low cost, diversified, boring, and perfectly suited to the patient, humble investor who knows she can't predict the future. The rise of fractional shares and commission-free trading apps makes it easier than ever to start compounding early. But the ease of trading also makes it easier to break the compounding chain through impulsive decisions. The technology amplifies both the best and worst of human financial behavior. Global investing platforms allow for geographic diversification, offering a practical solution to the reality that any single country's market can experience a lost decade. The ability to own a slice of the global economy with a few taps is a historic advantage. The psychology of money, applied to today, is this: the world will always give you reasons to be fearful, greedy, impatient, and envious. The tools to act on those emotions are now in your pocket, available 24 hours a day. The discipline to use those tools wisely, to automate your savings, to invest in broadly diversified, low-cost funds, to ignore the noise, and to define wealth as freedom rather than status, is the modern superpower. It is not intelligence, it is behavior, and behavior, as we've learned, is everything. To see what that looks like in human form, let's walk through 3 lives shaped by these principles. Meet Sam. He's 26, a software developer at a mid-sized tech company. He earns a good salary, but after rent, student loans, and weekend outings with friends, his bank account barely moves. He's not struggling, but he's one missed paycheck from anxiety. He reads The Psychology of Money and is struck by the chapter on freedom. He realizes he's been trading his time for a salary, and then trading his salary for a lifestyle that keeps him tethered to the job. He doesn't hate the job, but he hates the fragility. He decides to make a change. He calculates his savings rate for the first time, a dismal 4%. He starts small. He automates a 15% deduction from his paycheck into a tax-advantaged brokerage account, set to buy a global index fund every month. He cooks more at home, cancels subscriptions he barely uses, and starts tracking his net worth, not to obsess, but to see the quiet progress. 3 years later, he has a 6-month emergency fund and a growing portfolio. The market dips during that period, but because he has room for error and a long horizon, he doesn't panic. In fact, he sees the dip as an opportunity and continues his automatic purchases. At 30, he's not rich, but he's financially independent enough to take a sabbatical and build his own app, something he dreamed of but never had the courage to try. The lesson: a high savings rate and a focus on freedom over stuff turned a fragile salary into a platform for autonomy. Now consider Maria, a 45-year-old marketing director at a large corporation. She's been climbing the ladder for 2 decades. She has a beautiful home, a luxury car lease, and a wardrobe that announces her success. But she's exhausted. She sleeps poorly, her marriage is strained, and she secretly dreads Monday mornings. She reads The Man in the Car Paradox and feels a jolt of recognition. She's been buying things to signal success, but the signals aren't making her happy and they're consuming her income. She and her husband have a high combined salary, but their savings rate is negative. They're accumulating credit card debt. Maria initiates a hard conversation with her husband and they decide to downsize. They sell the big house, move to a smaller one closer to family, pay off the debt, and invest the equity. Maria negotiates a reduced schedule at work, trading some income for time. The transition is difficult, her ego takes a hit, but within a year she feels 10 years younger. She starts a small gardening consultancy on the side, not for the money but for the joy. Her marriage improves. She's earning less but keeping more, and her life is finally her own. The lesson: invisible wealth. The money not spent on status bought her the most visible joy, a life she didn't need to escape from. Finally, there's David, a 52-year-old entrepreneur who built a successful manufacturing business. He sold it 3 years ago for a sum that on paper should have set him up for life. But after the sale, he felt lost. He'd tied his entire identity to the business. He also made a classic mistake. He took a large portion of the sale proceeds and, on the advice of a charismatic wealth manager, invested in a concentrated portfolio of high-growth tech stocks. When the tech sector corrected, his net worth was cut nearly in half. He was devastated. He found Housel's book and realized he had violated multiple principles. He had no room for error. He'd let a story about tech dominance override diversification, and he hadn't prepared for the psychological shock of losing his identity. He fired the wealth manager, moved his remaining money into a diversified, low-cost portfolio, and committed to not touching it for a decade. He also began volunteering with a nonprofit that helps young entrepreneurs, slowly building a new identity based on service, not just success. His wealth, though diminished, was still substantial enough to fund a comfortable life. The lesson: staying rich is harder than getting rich, and it requires humility, diversification, and a self that exists beyond the bank account. These stories share a common thread: a moment of honest self-awareness, a willingness to change behavior, and a focus on the quiet, invisible side of money: freedom, flexibility, and peace of mind. The question is, how do you write your own version of this story? Let's build the action plan. The following steps are drawn directly from the principles of the psychology of money. They are not about picking the right stock or timing the market. They are about engineering your own behavior so that you can live a richer life, however you define rich. Step 1. Calculate your true wealth. Write down your total net worth, assets minus liabilities. Then beside it, write down the number that represents 6 months of your essential living expenses. How many months of freedom does your net worth buy you? Why do this? Because wealth is not a number on a screen, it's a measure of autonomy. A common mistake is focusing only on the total and ignoring the purchasing power over your own time. The expected outcome is a shift in perspective from accumulation to liberation. Step 2. Automate your savings to widen the gap between your ego and your income. Set up an automatic transfer of at least 10% of your after-tax income into a separate account that you don't touch for daily expenses. Why? Because the savings rate is the single most controllable lever in financial success. Example: every payday, money flows automatically to an investment account before you can spend it. Mistake: setting the rate so high that you constantly raid the account. Start modest and increase slowly. Outcome: a growing, invisible asset column that silently compounds. Step 3. Build your room for error. Establish or replenish an emergency fund in a high-yield savings account that covers 3 to 6 months of basic expenses. Why? Because the unexpected is guaranteed, and a cash buffer is the difference between a crisis and an inconvenience. Example: when the car breaks down or the medical bill arrives, you pay it without touching investments or going into debt. Mistake: investing your emergency fund in volatile assets. Keep it boring and liquid. Outcome: sleep. Literal, restful sleep. Step 4. Examine your money stories. Set a timer for 15 minutes and write your answers to these prompts. Money is, rich people are, I'm the kind of person who with money. Why? Because unconscious narratives drive most financial decisions. Mistake: editing your answers to sound good. Write the raw, honest first thoughts. Outcome: self-awareness that opens the door to behavioral change. Step 5. Practice the man in the car test. The next time you are about to make a significant discretionary purchase, clothes, a car, a gadget, pause and ask, am I buying this for myself or for the imagined admiration of people I don't even know? If it's the latter, delay the purchase by 1 week. Why? Because wealth is the money not spent on status signaling. Mistake: using this as a blanket ban on all pleasures. Outcome: a spending pattern that aligns with your authentic values, not your social anxieties. Step 6. Curate your pessimism intake. For 1 week, log every piece of financial media you consume. Note whether it made you feel anxious, greedy, or at peace. Then unsubscribe from at least 2 sources that lean heavily toward fear-mongering. Why? Because pessimism is a product and you're paying for it with your emotional bandwidth and your compounding. Example: replace a doom-scrolling YouTuber with a long-form documentary on the history of innovation. Mistake: seeking out only feel-good fluff. The goal is realistic, data-grounded perspective, not empty positivity. Outcome: a calmer, clearer mind that can stay invested. Step 7. Write a letter to your future self. Project 10 years ahead. Describe your ideal daily life, your priorities, your worries. Then look at your current financial plan and ask, does this plan assume I will still be the same person in 10 years, or does it allow for change? Why? Because the end of history illusion guarantees you will evolve. Mistake: locking yourself into rigid plans that demand static preferences. Outcome: a flexible financial framework that accommodates your future self. Step 8. Define enough. On a single page, write down what enough looks like for you. Not a net worth target, but a description of a life that feels sufficient, the point at which more money would not meaningfully improve your well-being. Why? Because without a definition of enough, the pursuit of more becomes a treadmill without an off switch. Mistake: setting a moving target that always recedes. Outcome: a guardrail against greed and a compass toward contentment. Step 9. Make one reasonable optimization. Identify one area of your financial life where you've been pursuing a perfectly rational strategy that doesn't fit your personality and adjust it to be more reasonable. For example, if you're holding 100% stocks because the math says that's optimal but you can't sleep during volatility, shift to a mix that lets you stay the course. Why? Because reasonable beats rational when it's sustainable. Outcome: a financial plan you can actually stick with. Step 10. Share one lesson. Teach a friend, a partner, or a child a single concept from this book. Compounding: the man in the car paradox, the difference between getting rich and staying rich. Why? Because teaching is the highest form of learning, and financial literacy spreads best through conversation, not lecture. Outcome: deeper understanding and a community that reinforces wise behavior. These 10 steps are not a sprint. They are a rhythm of thinking, acting, and reflecting that over time transforms a chaotic financial life into a deliberate, resilient, and ultimately freeing one. We began with the story of Ronald Reed, the janitor who amassed a quiet fortune through patient, unglamorous behavior. Every principle we've explored since then has been an unfolding of the lesson his life embodies. Money is not a machine you simply optimize with enough intelligence. It is a mirror that reflects your psychology, your history, your fears, and your values. And the path to a good relationship with money is not through superior calculation, but through self-understanding. We learned that no one is crazy. Each person's financial decisions make sense in the context of their own experience. Luck and risk are the invisible twin forces that shape outcomes far more than we like to admit, and the appropriate response is humility, not arrogance. Getting rich is one skill, often driven by boldness and risk-taking. Staying rich is another entirely, built on paranoia, humility, and the quiet art of not losing what you have. Compounding is the engine that rewards patience above all, but it requires time and an iron will to avoid interrupting the process. True wealth is the ability to control your time. It is the freedom to wake up and say, I can do whatever I want today. That freedom is funded not by high income alone, but by a high savings rate. The gap between what you earn and what you spend, between your ego and your income. The visible trappings of wealth are often its enemies. The Ferrari is a monument to money already spent, while real wealth is invisible, sitting quietly in accounts that buy tomorrow's freedom. We are all subject to the end of history illusion, constantly changing in ways we don't anticipate, which demands flexibility in our long-term plans. The future is surprising, so we build room for error and prefer reasonable plans we can stick with over rational plans we abandon. Pessimism seduces us with its intellectual glamour, but disciplined optimism has been the long-term winner. And the stories we tell ourselves about money, often hidden from our own awareness, are the scripts that determine our financial fate. These principles are not a checklist. They are an ecology. The person who saves without purpose becomes a miser. The person who takes risk without humility gets wiped out. The person who seeks freedom but inflates their lifestyle remains chained. The balance is everything. The harmony of these principles produces a life that is not just financially resilient, but deeply, authentically rich. And so we arrive at the end of our exploration, though the real work, of course, is just beginning. Morgan Housel wrote a book that is less about money and more about the human condition. He reminds us that finance is not separate from life. It is a thread woven through every decision, every relationship, every quiet worry in the middle of the night. To master money is not to conquer a spreadsheet. It is to understand yourself well enough to make peace with uncertainty, to define enough in a world that screams more, and to build a life that feels free even before the bank account says you are. The greatest risk in personal finance is not a market crash or a recession. It is a life spent chasing a version of wealth that was never yours, measured by a yardstick borrowed from strangers. The antidote is to go inward, to define what you truly value, and to align your money with that definition, quietly, patiently, one decision at a time. No single book contains all the answers. The psychology of money is a conversation starter, not a final word. It will challenge you, comfort you, and occasionally convict you. If any of what you've heard today has resonated, I encourage you to find the original book, to read it in your own voice, to argue with its margins, and to let its stories sink into the deeper layers of your thinking. A summary is a map. The book is the terrain. Let me leave you with this final thought. Money, in the end, is just a tool. It can buy comfort, freedom, and the ability to help those you love. But it can never buy a single extra minute of time once that time has passed, and it can never substitute for the quiet contentment of a life lived on your own terms. The goal is not to die with the largest pile. The goal is to live so that your money serves your life, and never the other way around. Understand your psychology, and you will have unlocked the only wealth that truly matters. The time to begin understanding is not next month, not next year, not when you have more to invest. It is now, in this quiet moment, with the resources you already possess and the mind you already have. Go build a life that needs no vacation.